Corporate Finance Presentation, Capital Markets Overview. Get ready, it's time to take your chance with Corporate Finance. Types of security markets. We have the money markets and the capital markets. Our focus here will be on the capital markets. The money markets are going to be the short-term markets, has securities with maturity dates of 1 year or less. They include things like the treasury bills, the commercial paper, and negotiable certificates of deposit. The capital markets are going to be the long-term markets with securities that are greater than a year. They include things such as bonds, common stock, preferred stock, and convertible securities. They comprise a company's capital structure. In other words, when you think about the company's capital structure, if you think about basically the accounting equation, assets equal liabilities plus equity, we have the equity, which represents ownership by, if it were a corporation, the owners, the stockholders, and then we have the liabilities, which is basically the debt component of the capital structure of the organization. If we think about the typical scenario for a primary capital market, it's a situation where we have a business, possibly the business wants to expand, they need more capital, in other words, more money in order to do so. They would like to link up with people that have money but need to invest it somewhere. So we have excess capital over here looking for investments where they can get a return. We have a company over here that needs money and would like to take that money in order to invest it in order to get a return. So to connect these two up, obviously we're thinking the capital market, that being the primary market, the business can then give either stocks or bonds in exchange for the money. So the money, of course, going to the business then issues either equity shares, basically ownership in the company, equity shares in the company, which hopefully will generate a return, or they issue debt in the form typically of bonds would be the typical structure. Now the market then is going to be the facilitator of the transaction, the financial institution that's going to be facilitating the transaction. If you're talking about a primary market, then you have a situation where the company is the one that's basically issuing the stocks or bonds. So for example, if you're issuing the stocks, then the stocks are actually coming from the company, the money then going into the company, as opposed to the secondary market where the stocks are already out there and they're being exchanged upon or amongst the investors. So the money coming from the business in the primary market could be an initial investment, an IPO, or issues of stock after that point in time. But the point being that those stocks are actually coming from the business, in that case, in the primary market. On the secondary market, that's going to be a situation where you have individuals that own stock. They already have ownership of a particular company, for example. And then we have the other individuals, of course, that have money and they want to, once again, invest in somewhere, put that money somewhere. So you have a similar type of transaction, but this money isn't going to the business itself. It's going to other owners of the business who can then sell their shares. And that's what we typically think of when we think of ourselves as investors. When we're an investor in the market, typically we are dealing in the secondary market where people are exchanging amongst themselves. So we could get into a market, for example, and get the investments or the distribution from the company itself, like an IPO or the shares that are being issued from the company. But most trades on the market are going to be dealing in the secondary market. The secondary market's going to be really useful market because it allows liquidity. So the fact that you can then have the stocks and then you can have the ability to sell them makes it a lot easier to sell them if something goes wrong. So if something goes wrong, you can back out of what, your investment a lot more easily. It makes the stocks a lot more liquid. The fact that the stocks are going to be a lot more liquid due to the fact that we have a secondary market is going to make them much more attractive to people to invest in. The fact that people are more attracted to invest is typically a good thing because that might raise capital that will be available to, at some point, hopefully get into the investments so that everybody wins here. The people that are investing money can put their money somewhere, get a return on it, and the businesses that need money so that they can invest it in order to get a return have the money then to do so. Obviously, a transaction like this would be the facilitator, would be the stock exchange. Once again, we need the financial institution to help facilitate the exchanges, the financial institutions, and the integrity of the exchange itself to be transparent and do the exchange appropriately is going to be another important component when we're investing money through an exchange and putting money into the business. We got to be sure that everything is transparent, that we trust the system, the financial institutions, and the businesses that will be involved. The security, the stock exchange will be involved in that. Regulatory agencies like the SEC will be involved in helping us with that trust component, and requirements of companies to be on a public exchange will help us with the trust component as well, which may include things like audits of the companies. Then we have the international capital markets as a fund source. Help companies get debt and equity capital at the lowest cost. So if we have international markets, then of course we have a larger market, larger opportunity, and that's going to allow, hopefully access to more capital, and that'll help, have a market for capital, which should drive down the costs for the capital. And that will be good for the companies to get debt and equity capital at the lowest cost. Listing common stock increases liquidity for the shareholders. So in other words, if we have a company that's going to be listed on other exchange, including international exchange, and you have access to your stock, and if you're an owner of the stock, you have more capacity to sell the shares, not only on one exchange, but multiple exchange, increasing the ability for you to make a sale. Even if something happened to one exchange or whatever happened at one place, you have more capacity to sell, and you have more capacity to sell to more people. That increases the liquidity. It allows you to basically sell it. It makes the stocks closer to, like, most liquid asset would be some kind of currency. So the stocks being closer to some kind of currency, given the fact that you have the ability to exchange them and a wider rate, is going to allow people once again to want to invest more in the stocks themselves. Allows for the ability to sell stock in foreign countries. Fund competition in U.S. capital markets. So if we're a company trying to get access to capital on these markets, then there are going to be competition from governments as well. We have securities available on the markets, which would include the federal government, the government agencies, state governments, and local municipalities. The structure and risk and return will be different between corporate and non-corporate securities. So if you're thinking from the investment side, you're probably aware of this when you're thinking about what you want to be investing in as a financial investment. Do you want to have government type of investments, or do you want to have corporate type of investments? You might want to balance the portfolio to get that diversification. Obviously, from the corporate side of things, when we're thinking about generating capital, we need to take that into consideration as well.